Hi, everybody, and welcome to the November edition of the PE Pulse podcast, where over the next 8 to 10 minutes or so, we'll give you a rundown of the important themes and trends in the private equity space and give you our views on how today's macro environment is impacting private equity. My name's Pete Witte, and I'm part of the private equity group here at EY, and I appreciate you taking the time to listen. So let's get started. So it's fall where I live, and I know it's a little hokey, but it did occur to me that it's not a terrible metaphor for where we are in the market right now, right? The seasons are changing, the robustness of summer is winding down, and it's being replaced with rougher winds, at least for a little while. And we talked about this last quarter, right? How activity had actually held up pretty well through the first half of the year, all things considered, but that given the macro dynamics, we should expect a more significant measure of slowdown across the board over the next several months. And that's exactly what we've seen, right? So deal sizes are getting smaller. We're seeing pivots toward more recession-resistant sectors and strategies. We're seeing modest declines in fundraising and then more significant declines in exits. So we'll double click on each one of these and we'll start with deals. First half of the year, we saw declines of about 20% versus 2021. And that really wasn't bad considering last year was the busiest ever for private equity. When we rolled into mid-year, we were basically saying, look, number of deals is down, but it's basically about where it was pre-pandemic. In Q3, though, that deceleration really intensified. So right now, we're seeing about 20 to 30 significant private equity deals every month. And by significant, I mean anything over $100 million. Before the pandemic, we'd see about 35, 40 every month. At the height of the recovery last year, we'd see somewhere around 70 or so. In September, we saw 25. And by value, we saw a decline of just over 50% between Q2 and Q3 of this year. And there's clearly a number of reasons for that, right? The outlook's gotten a lot cloudier. You have the usual disconnect that we see between buyers and sellers and the valuation gaps where folks have a hard time coming to the proper price. But more importantly, there's the dislocation that we've seen in the financing markets and the challenges that some of the large banks have had in offloading the debt that they took on to finance some of the larger deals in the early part of the year. And so where last year we saw almost $1 trillion in leveraged loan issuance, this year it's been about $350 billion all in. And a lot of that was in the first part of this year. And again, Q3 is where we really saw things start to slow down about 50% from Q2 on the financing side. So spreads have widened, yields have gone higher to the point where financing costs for current LPOs sitting in the 9 to 10% range. Now that's based on a pretty small handful of deals, right? So if the market gets comfortable with the direction the Fed's taking, if inflation starts to come back under control, then we could very well see these spreads decline a little bit and financing costs start to back off some of those levels. But as a result of that, the locus of activity for private equity firms has really shifted down markets, right? Where valuations have moderated, financing is more readily available. And so we've seen more add-on transactions in particular. Typically the market's around 50-50 between platform deals and add-ons. Right now it's around 60-40. And what's interesting is the degree to which the financing for a lot of this is coming from private credit providers. They've been really active in filling the gaps while the syndicated market has been pretty much closed off. Last year, for example, private debt made up about 1/3 of the total financing market for private equity deals. In Q2 of this year, private lenders made up about 55% of the total market. Q3, I haven't seen the stats yet, but I gotta think it's even higher. And I think that's one of the real key stories that's going to come out of this market, right? Is private credit lenders teaming up to take down larger and larger deals. That was something that was already happening before this year, but it's this kind of environment that's really going to accelerate that. You look at some of the largest private equity deals over the last few months, and a lot of that financing has shifted over to the private side. So we just saw a large deal in the tech space, for example. They got a $2.5 billion financing package from a consortium of private lenders. And so in that way, it's very much mirroring what we've seen on the equity side, right? Where more and more capital markets activity is shifting from public sources of capital to private. And then the last thing I'll say here is that they certainly have the capital to execute on that, right? So about $450 billion in AUM across the various credit platforms. And what's interesting is that 250 of that is dry powder. So the amount of dry powder actually exceeds the amount that's invested right now, which, given where the market is probably headed, is a pretty good place to be. And so now we'll talk about exits for just a minute. Frankly, there's not a whole lot to really comment on around this. Exit activity has fallen off a cliff this year. Nobody's going to sell when the market's down 20% unless you really have to. And for most private equity firms, they've been such active sellers over the last few years. Very few of them really have to. So there's less recycled capital that's floating around. That's ultimately going to impact fundraising. In total, we saw a drop in exit activity of about 67% in the third quarter versus the second quarter. And the vast majority of those were sales to strategics. We've really just seen a small handful of IPOs this year. Lately, it's been the same with secondary exits as well. So really just limited activity here. I think people, for the most part, are pretty content to wait out the downturn and just kind of sell when things pick up again. And for those that can't or don't want to do that, we've talked before about the options that they have with respect to, continuation funds and LP and GP led secondaries and so on. But ultimately, that downturn in exits is going to affect the fundraising market, right? And we've seen some of that already. Firms have raised about $385 billion so far this year. That's 8% lower than last year. And then in Q3, again, that slowdown really started to accelerate a bit. Activity down about 13% versus the second quarter. Now, what's interesting about the fundraising market, though, is some of the stats that we see around who's actually getting funded, right? Because there's this real bifurcation, I think, that's happening in the market right now. And I kind of had a hard time reconciling this in my mind at first, because we know that the overall market for fundraising is down. But at the same time, for a lot of the really large private equity funds, they continue to report that they're bringing in, huge amounts of capital. So when the Q2 earnings figures came out, for example, we actually saw AUMs go up at a lot of the funds, despite taking write-downs in the portfolio, because the capital coming in was more than sufficient to offset those write-downs. So I think while LPs can't fund everything that they want to right now, they certainly continue to fund their largest and most significant managers. And then the other tailwind that you've got here is fresh capital that's coming into the industry for the first time, right? So about 80% of the industry's capital comes from recycled distributions. About 20% of it comes from new money. Most of that comes from high net worth individuals, family offices, and so on. And that tends to favor the larger managers, right? Because in a lot of cases, they're the ones who have made the investment in building out those channels. And so for that population of managers, that's going to offset some of that pressure from declining distributions a little bit, right? And that's very much by design, right? Where firms are being very deliberate in diversifying their funding sources in the same way that they've diversified their deployment strategies. So the open question is this, where do we go from here? And it's tough, right? Because the market's being driven by these massive macro factors that can go a lot of different ways. But I think what we know is this, right? From a deployment perspective, we'll see a continued shift away from cyclicals and growthier opportunities and into the value end of the spectrum. Over the immediate term, there's probably a continued preference for smaller deal sizes, so more add-ons, more buy and build strategies. And then over time, as the syndicated market recovers, we'll see the return of scale again. And we'll see folks being really creative in the types of deals that they're doing. So firms are looking at the infrastructure space, they're looking at credit, certainly. They're looking at certain spaces in real estate. They're looking for companies with high barriers to entry, with long-term contracts, with the ability to pass along higher costs to their customers, all things that give them a little bit of a hedge against the macro. And then from a portfolio perspective, it's really sort of a reversion to the pandemic playbook, right? Where you're looking at your portfolio, you're figuring out where the trouble spots are going to be, and then working to address those in a way that optimizes the value of the fund. And in particular, you're looking very closely at cash situations, runway, your treasury function, getting visibility into all of those things. You're going to look to control costs as best you can. And then in this environment in particular, you'll look very closely at your pricing strategies and whether those continue to make sense in light of the inflationary environment that we're seeing. And our folks have been very busy helping companies with all of those things over the last several months. So the bottom line, it's an interesting environment. There's a lot of variability and potential outcomes over the next few months, depending on how quickly central bankers are able to resolve some of these inflationary pressures and at what cost all of that comes to the real economy. But I've said it before, I think it's worth saying again that the long-term secular trends here are really driving the bus when it comes to private equity. And they will continue to remain intact. They'll offset a lot of the cyclicality that we're seeing and will likely see for the next few quarters. So that's it for today's podcast. Thanks as always for listening, and I will see you next quarter with another update.
Thanks for tuning in to the EY Next Wave Private Equity Podcast. For more thought-leading perspectives and to get in touch with Wayna Brown, visit ey.com/private equity. You can also follow us on Twitter at EY Private Equity. We'll see you on the next episode.